Okay, good afternoon, everybody. I see a number of you are still joining, but welcome to our Let's Talk Offshore Property webinar today. I'm very pleased to be joined by an excellent panel of specialists that will be able to unpack why offshore property is such a pivotal part of our investment strategy and why you should be thinking about it to diversify your assets offshore. There is a section at the end for answering questions, and I'd ask that you utilize your Q&A button, and we'll try, and that's at the center of the screen for those that haven't used Zoom before, down at the bottom, and we'll do our best to get all those questions together and answer them all at the end. So thank you everybody for taking part. Okay, so the host today from Holborn's perspective, you've got myself, Mark McAllister. I'm the senior partner here for Cape Town, and then Lourens Reichert, who is our managing partner for the African region. So for those that don't know Lourens, I'm sure that you will have seen stuff before, but just to underline again, not only does he head up one of the largest independent wealth teams in South Africa, he also chairs our investment selection committee for our nearly $3 billion of assets globally, and is a very, very big supporter of the importance of investment property as a cornerstone within our offering. So a little bit about us, just to welcome everyone. So Holborn has been around for over 20 years now, and today we're still the second largest independently owned IFA in the world. And we've got assets under management across the group of circa $3 billion US, and that's spread over about 20,000 clients and about 18 different offices in numerous countries around the world. What are the 5 pillars of our success? Well, firstly, let's talk about that size. So what do you get from us by working with a provider with that amount of assets under management? Well, firstly, we get access to institutional discounts, and we're able to bring in providers like the likes of IP Global on the property side, and their chairman will come and speak to us and our clients and tell us exactly what's going on in the market. So with that scale comes a certain amount of discount that we pass on to our clients. From an independence point of view, we are a completely independent financial advisory. We don't have any fear or favor. We don't have to use certain types of funds, just because the name is above the door. Actually, the vast majority of everything we do is completely independent of Holborn, so that that you're getting the best advice with complete impartiality. And that's the same on the offshore property offering. We work with a number of different developers around the world, and we do all of that due diligence for you so that you're working with the best partners available. From a service perspective, we're very happy to announce that yet again, Holborn has won a number of awards at our international industry Oscars. So there you've got the awards for 2019 and 2020, but we've also just recently won again for 2021. So we picked up 6 out of the 24 categories. So that underlines that service is very important to us, and it's got a very sort of bespoke private banking feel to it. We aim to see our clients every quarter and make sure they know exactly what's going on with their investment portfolios or their investment properties wherever they are around the world. From an education point of view, we're also the most educated and best qualified advisors in the industry today. So we do all of our qualifications here in South Africa, as you would expect. But also what we do is ensure that our team are all educated to the same Chartered Institute of Securities Investments standard from London, which is really the global benchmark on IFA education. So something there that's very important. And finally, safety and security. And I'm sure that's one of the things that will be discussed today, is how do we make sure that we look after your money in the long term so you can put your head on the pillow at night and sleep soundly. And using things like investment property is a great way of diversifying risk, whilst also using the kind of jurisdictions that vehemently protect things like your property ownership rights, but also sometimes will provide government-backed investor protection on other sort of investments as well. From an offering perspective, I won't go into this too much, but you can see we've got a very large product suite. And everything from trusts, offshore companies, offshore property that we'll be discussing today. If you're looking to get a new passport, citizenship by investment, and also alternative assets. But a key part of the message today will be, how do we use the power of leveraging? And I won't steal too much of the guy's thunder, but Robert Kiyosaki very famously said, grow your wealth using other people's money. And we'll show you how to do that through our offshore mortgages and lending team. Last little bit from me, just confirmation of where we are around the world. So a lot of very regulated countries, so the likes of obviously South Africa, our MiFID license in Europe, obviously in the UK, now also in the USA. So very, very proud of all of that. So I'm going to hand over now to Lourens, who's just going to do a little bit of an introduction to our speakers today, and look forward to hearing from them on the subject topic. So Lourens, over to you.
Thank you very much, Mark, and hello everybody, and hello from Dubai. My first travel out of South Africa in 2 years and 1 month. And we came here for a quick stop, and it's wonderful to be here. So just a couple of things now. I'm not really going to steal the IP Global Thunder today. What I'm more going to do is give a broad overview of what's happening out in the world, and why asset classes are so important as part of a whole portfolio. So first things first is this most recent market correction in January. Now, the last time we saw such a sharp correction, of course, was when COVID hit. And it's almost as if clients didn't really notice, because they were too worried about what's going to happen to business. They were too worried about what's going to happen with lockdown, and is this virus as deadly as what it seems? Most people just did not even bother picking up the phone to us when the market corrected by some 35%. Different though this time around, when the market corrected, it corrected quite sharply in January, and everybody's kind of over the COVID thing, and my phone could not stop ringing. The market didn't even correct half as hard as it did 2 years ago, but my phone did not stop ringing. And for the first time in a very long time, I've had a scenario where clients have said, I want to encash my portfolio, and some actually did. It's quite mad, really, because it was the best thing for those clients 6 months ago, and then all of a sudden the portfolio that they've got is not the best thing now. But of course, in some cases you can pull the trigger. In some cases you can actually pull the trigger and say, right, that's it. I can get out of this market. Now, if, however, you were in the property market, you cannot pull the trigger that fast. And I don't always think that liquidity is a good thing, because I'll tell you a quick story. In 2008, or actually late 2007, I was living in London, and I had put an offer on a property on the Finchley Road, right across from the O2 Centre. And it was a 2-bed flat for £310,000. And for whatever reason, it was something to do with a temporary visa that wasn't yet permanent. The bank who I wanted to lend from, Northern Rock, did not want to give me the mortgage. And so I thought, I will just have to wait a while until I get my permanent residency. And then the financial crash of 2008 happened. And that same property in Finchley Road did not sell for 310,000. It dropped all the way down to about 240,000. But I never got the mortgage, and I was so thankful. I was so happy that, it must have been the gods out there that smiled on me that I wouldn't get this mortgage for something that went from 310 all the way down to 240. And had I gotten a mortgage, it means I would have had to hang on to that property because no one was buying. And so I would have just had to sit on it. And had I still sat on it today, it would be worth 1.2 million pounds. And that was my first lesson in the fact that liquidity is not always a good thing because people can crystallize loss. And the other thing is, and this is a diversification conversation, it's not always good to put all the eggs into one basket. Of course, you shouldn't all have it in property because it is illiquid, and so sometimes you need cash. But if you are just going to favor one asset, sometimes you could come unstuck. I'll give you an example. If you favorite the NASDAQ as an asset in the worst crash that the NASDAQ has ever had, which was the dot-com bubble crash, you would have had, and that's a developed market, that's a New York listed stock exchange, you would have had to wait 14 years, 14 years for your money to recover. Compared to property in a developed market like New York or London, in the biggest crash property has ever had, and you would have had to wait 4 years for it to recover. Those sound bites made me realize that I cannot just have all my eggs in one basket. And if you look at my personal portfolio, you will see that maybe one quarter of my portfolio is in liquidity, in very, very aggressive liquidity. If it was trading at 100 in November, it was trading at 53 in January. That's how aggressive it is. But of course, it's not something I'm worried about because I don't need my money for the next circa 15, 20 years. So I just write it out. But my property portfolio is where the other three quarters of my wealth sits, and that has not even moved. It hasn't even felt this effect of what's happened globally in the crash, etc. It's only steadily gone in one direction. And so as a result, what I thought we'd do is we'd talk why one has to have both the liquidity and the assets that we typically manage through stock portfolios, fund partners, etc. But also why must you have a property portfolio? And also, why will a property portfolio, I would say 9 out of 10 times, outperform a stock portfolio if you can borrow the bank's money? And so for those reasons, I think it's worthwhile bringing in the expert. The one final thing that I would say with regards to property is the horror stories you hear on property is not a market correction and a market crash. Those are not the horror stories. The horror stories are things like developers going bust. The horror stories you hear are people running away with people's money. The horror stories you hear is everybody is developing property. How do I know which is the right one? Because I don't want to come unstuck. And that is for me the reason I look at partners like IP Global, because I think their recipe is the proverbial finding the needle in the haystack. And so without any further ado, I'm going to introduce to you Will and Tim. And Will heads up their global sales here out of Dubai, and Tim is the founder of the company. I've worked with them for many, many years, and I am also their client. I've bought property in Germany, followed by property in Portugal, followed by property back in Germany with them, and they are my personal favorite, certainly European partner to buy my own properties through. And also in every development where I have my own money in, I have clients as neighbors, and some of them will be on this call. But none of my clients have actually heard these two guys speak. So we'd love to hear from Will and Tim, just with a little bit about how to diversify your asset base away from seriously heavy corrections. The questions that we can ask later, we can ask certainly about, because Tim's been through the global financial crisis, how do you get through it? How do you defend against the next one, etc.? Of course, the questions will come up with regards to rising inflation, rising interest rates, etc. So those questions we'll ask all later. But right now, really, we want to speak to them about their business, about property as an asset class. So gentlemen, over to you.
Lourens, Mark, thank you very much. It's very interesting listening to that. I think we will be able to make this presentation slightly shorter on the basis that I think the questions are more important. And also in Lourens' short stories there. I think a lot of lessons can be learned just from hearing those. And I kind of knew the punchline because I've been there, but it was absolutely fascinating for him to talk about that particular property on Finchley Road. Before Will starts to talk through a few of our slides, just a quick bit on me and a little bit of track record and background to our business. So as I was listening to the guys speak there, I was reminded, I was just starting to tot up that in October, in fact, on the 17th of October this year, it'll be 30 years since I bought my first property, which is slightly scary. And there began my property buying addiction that later turned into me setting up IP Global, which is now a little bit short of 17 years old. So during that period, I personally have bought a lot of property and still maintain it. And obviously the company has bought and sold property on behalf of its clients during that period. In actual fact, we are heading, not quite, but on our way to our 3 billion mark that Holborn has achieved, albeit they still manage 3 billion. We bought and sold, but we bought and sold between 2.5 and 3 billion US dollars of property since we first started the company. During that period, since October 92, I've seen certainly two global financial crises, one massive one, which we can talk about a little bit later. And I didn't have time during the introduction there to work out how many inflationary cycles and deflationary cycles as well that we've witnessed. But certainly, again, when we do the Q&A, we can talk about the impact of those market dynamics on the achievement of your property returns and also your yields and things like that. Finally, before we get into a few of these slides, virtually everything on here, apart from a couple of the global pieces of property economics, is data that we've got from our own portfolio. And I think it's important to talk about that because Lourens hit the nail on the head. It isn't the asset class that ever lets property down. It's the type of property or the advice that you, the developer that you're working with, the advice that you're given, or sometimes incorrect data being quoted or quoted in the wrong way. And I think it's very important, and we're very particular with making sure that the data we talk about with regards to return on capital, return on property asset value, yields, are real stories and real examples of what actually does happen, because you do see all sorts of rental guarantees out there in the market that are not necessarily realistic. And certainly with inflation here to stay, one would think, yields and cost of funding are going to be very important factors when it comes to buying real estate. So if we can pull up the first slide, Will, and I'll do this one because this is very much about IPG, and then we'll get into some of the other stuff with yourself. Sorry, the second slide. There we go. Okay. So Lourens talked before about Germany. This is a little bit about track record from our perspective. So since 2009, and indeed we didn't actually invest our money or our clients' money in the UK in the latter part of the 2000s until 2009. And since then, we've invested over 1.7 billion pounds of our clients' money in UK assets. And you can see other markets that are notable as well. Germany, that we're still very, very busy with Germany, 17 projects for 110 million euros. Why not more? It's hard to find. We would do more in Germany. I mean, we love places like Leipzig and Berlin, but it's a very tough market to get into. But we've invested over 100 million euros there. Australia, 190 million Australian dollars, and the US, 150 plus million dollars. And just going over to the second part of the slide, we own a company called Complete. Many of our clients use it for rentals, not all of them, but 90% of them do. And you can see some of the stats there with regards to what we've done with our performances on our clients' assets, because while buying it's the most exciting and scary part of a property investment, certainly the important part, the meat in the sandwich, is the rental yields and the rental of the property. So you can see some of the data on there. We manage over 2,000 units. An average tenancy is about 14 months. The rental increase average is 3%. I think the biggest number on there for me, because you can see the rest for yourselves, but the most important number is our achieved rent versus forecasts. Every property we talk about with our investors, we show them the cash flow forecasts, and they can be very misleading if they're in the wrong hands. And we like to under promise and over deliver, because the last thing you want is to be expecting to get £1,000 a month and end up getting 700 and having a huge shortfall, unless you went into that with your eyes open at the beginning. So it's very important that we make sure that we don't underachieve with our rental yields. And then you can see occupancy rates all in the high 90s across those markets, London being obviously the best one. We had a few challenges during COVID, but really nothing like what we would have expected to have had. Okay, so Will, I think if we can just jump into a few, if you'd like to just jump through a few of these relatively quickly, I think rather than me dominate the whole presentation.
Thanks, Tim, and thank you for the introductions to Mark and Lourens. It's great to have Tim on today, you know, to add a bit of value and that experience that he's had in the industry over the period of time he's been doing things. So yeah, Tim will comment as I sort of work through these things. But ultimately, you know, IP Global has been, I mean, Tim, this is probably one of the first sort of slides you probably ever drew up. I'm sure it looked a bit different and used some different graphics, but ultimately the business was driven by an ex-banker looking at, you know, supply and demand imbalances, looking at cities where population growth was happening and was going to happen, right, predicted to happen, looking at the economic data to make sure that underpinned the property market. And then obviously, you know, looking for exciting projects that were going to regenerate parts of cities or towns, you know, major train lines that were going to rapidly reduce commutes from certain spots in towns. I mean, things like Crossrail in London would obviously ring a bell with a few of you that know London. And then on a sort of smaller scale, looking to work with the right partners, as Lourens touched on, making sure that you understand, you know, the legalities of ownership in those different countries. Tim, how many countries have you bought property in personally?
Do you know, I haven't counted it up, but when I set the company up, I'd invested in 10. So that's going back however many years, to September 2005. So there might be one or two more markets since then. As I've got older, I've got to be honest, I've kind of got more boring, as most people do in terms of my investment strategy. I generally think there's two types of people who buy property. There's people that make all their money in buying property and then need to meet guys like Mark and Lourens to get advice about other asset classes because they don't know much about them. And there's people that make lots of money in other facets of their life and then realize that you're crazy to have a lot of money and not buy real estate. So I'm definitely the former. But these days, you know, I've got property in 6 countries, but the vast majority of my portfolio is in Germany and the UK. So yeah, those slides there were just, I mean, I used to work in financial services and banking. So, you know, it's very much like if it was somebody like Lourens or Mark decided, you know, to jump ship ever, they would apply everything they learned from their 15, 20 plus whatever years in financial services to the property market. And I feel sometimes people that sell property and talk to people about property don't always do it from the right aspect with regards to understanding currency risk, economic risk, and the kind of things that are on there. So this stuff is super important, you know, always buy in cities where there's a growing population, where there's always going to be supply imbalances with demand, which certainly are the places that we're investing, and where, you know, where more and more young people are going to come. You don't want generally, unless you're buying a holiday home, to be buying in a place where everyone's getting older. You know, I love data around, you know, in places like Birmingham in the UK, places like Berlin in Germany are getting young. The populations are getting younger. So, you know, university graduates are heading there. The new wave of businesses that I don't understand some of them, my kids know more about them than me, but technology businesses are heading to places like Berlin and Birmingham and even a place like Reading in the UK, which is a big technology drive now with a lot of Chinese firms. They're the places where it's very smart to buy property because they're your future tenants are coming from that population. Do you want to jump slides now?
Yeah. I think you sort of call that a bit of a recipe book. You know, you want to make sure that all of those things are ticked, and I think it's very easy to miss one or two of those things, and then suddenly you're in a market which you perhaps don't want to be in. Look, we've touched on this. Lourens has talked about security during tough times. He's talked about how long it took for the markets in the US to come back. I think it was 14 years. You know, it took, which really sort of rung a note in my head. So ultimately, property isn't that liquid at times. We buy in markets where liquidity is we try and maximize our clients' liquidity to a certain extent, you know, making sure they buy quality. But ultimately, that lack of liquidity does give it stability. And we saw that during the sort of COVID times. We were talking to a lot of our clients. I mean, I can't think of a client that sold a property during COVID because they couldn't, because the markets were actually kind of closed. Lawyers weren't transacting and you couldn't sell. And then when the market did open, there was this sort of, many government sort of stimulated investments and sort of reduced some tax benefits and things, and the kind of markets took off. So that lack of liquidity can benefit you if you obviously don't need the money. The next slide then, please. We'll skip on from that. Tim touched on this. I mean, it's, we've got many people in Africa on this call, in South Africa. I think currency and stability in currency is obviously a big reason why you're possibly on this call today. But not all of our clients are located in Africa. But it's important that you buy in the right way, that you don't see all of your returns wiped out by a devaluation in the currency. No doubt, Tim, you might have a comment or two on that.
Yeah. Look, I was in Asia during some crazy days of cross-currency borrowing, where banks were irresponsibly encouraging people to borrow money in currencies that were not the same as the underlying assets, which was a big thing in the noughties, and very dangerous. And we guarded our clients against that. For instance, a lot of people were borrowing yen because it was very cheap, and they were buying in Australia. But there's a reason why you might get a 6% rental yield on a property and you're paying a 1% cost of funds. The difference between the two interest rates is risk. And the greater the difference between the two interest rates, the more likely you're going to have a challenge at some point when the currencies go in the wrong direction. That's exactly what happened. People were put into a negative equity position because the bank were calling margins on people because people had borrowed in different currencies. Absolutely don't believe in that. I think it's craziness. If you're an FX expert or you want one, go and talk to your financial advisor or your bank, but don't try and mix that with property investing. You should always try and buy in markets where you have some confidence in the underlying currency. We have great confidence in the currencies that we invest in. They're stable. They will fluctuate, but then your borrowing is fluctuating as well. So certainly people in South Africa over the years have always found Eurozone, US dollar, GBP to be sensible havens for their money over the long term. And absolutely, you should be borrowing in the same currencies as the asset. Interest rates will come and go, and perhaps we talk about that a bit later. I think the only other thing that's important to cover on there is, from affordability perspective, it isn't your affordability that's important for a property market. It's the demographic that you're buying into. So I always talk about liquidity. If Lourens had bought that property, he should be trying to sell it to anyone who will buy it for the most amount of money, and that's more than likely to come from the local market. And that's where liquidity is, and that's where I scratch my head with people who buy in Phuket, in Thailand, and places like that, and Bali. If you're just going to go sit there and retire and drink your beer, that's fine. But if you're buying for investment, the liquidity is super poor in those markets. I'll slightly contradict Will here in that there's always liquidity in property, but it's how much you want to lose. So I know a lot of people who buy a lot of property during the worst possible moments, and they'll be knocking on your door and their lawyers will be working, I promise you, whether it's Christmas Day or not. But if you're prepared to wait a month, 2 months, 3 months, 6 months, then your liquidity and the right price will be there for you. But I absolutely believe you should be always buying where there's that population I talked about before of renters. They're also your buyers, but they're not your buyers yet because they can't afford to be. But Berlin, Leipzig, Porto, Lisbon, London, Manchester, Birmingham, all these great places, your tenants are your future buyers and people who are upgrading or moving from being tenants to buyers. So you want absolute liquidity by buying into markets where the population's growing and people can afford to buy a property. And again, that's where I scratch my head sometimes with Dubai. Although people have made good money in Dubai, people have lost money in equal measure. And that's mainly because actually the buyers and sellers are mainly investors. The amount of people that are actually owner occupiers is minimal, and that worries me about any property market, because that's got a bubble written all over it every time.
Very interesting. So interest rates is a topical subject at the moment due to a lot of the sort of inflation data that's been coming out of the US, where we're all thinking that we could see some marginal interest rate increases, but it's very interesting to see where we are sort of in the long term. So if you look back to 2003, quarter 1 2003, you can see where we started on this graph, and obviously the right hand side is where we kind of finished today. The blue line is the Eurozone area, and the yellow is the United Kingdom. So, you know, historically, rates are still incredibly cheap. I think it's the opinion, I speak for IP Global when I say that we could expect some small increases over the coming years. Does that mean that that's immediately passed on to the borrower? It doesn't always. I think, you know, when you go and try and borrow money, when the banks want to lend you money, when there's some profit in it for them, they become a little bit more open to lending. What we'll probably see if we do see some slight increases in rates is we'll probably see more banks coming into the market, and they'll probably have some quite attractive packages. They'll probably have a no arrangement fee arrangement or something like that. So you don't always see sort of interest rates passed on, and you do sometimes see sort of changes in the products that come to market. But money's cheap at the moment, and our clients are borrowing, and I can't think of a client in the last year and a half that hasn't taken a mortgage, because I've sort of encouraged them that this is potentially the right thing to explore. I would never push anyone to do anything, but within reason, if they can borrow some money and leverage that asset, then they're only going to increase their returns. Tim, I can see you've got a comment or two coming.
Yeah, sure. And I also am conscious of time, so I think we need to get through relatively quickly. But yeah, I think interest rates are coming. Well, people smarter than me will tell you interest rates are coming up. We had a lot of nervousness around this when the whole quantitative easing thing started to unravel post the last financial crisis, and sort of 2014, 15, 16. There's a lot of concerns about interest rates, but what you saw again was it was done very carefully and sensibly, and with management of the economies. I think already the US will be quite surprised at the immediate impact on equity markets that the recent news has had, and will not be particularly happy about it. Slight overreaction, as I'm sure the guys would agree with, but which has come back a little bit. So I think you'll see interest rates will need to come up. Generally, that's not great for equities in the short term, while everybody starts to realize that or work out what that means to their individual sectors. From a property perspective, quite honestly, it'll have a relatively marginal impact, because our clients should not be borrowing with the expectation that it's free to borrow money. So, but I don't see a huge impact on rates. And what we saw last time was banks starting to absorb. Banks have been very greedy with their margins in the last few years, because interest rates have been so low. Their margins have been horrendous. And what happened in the 15, 16, 17 is banks' margins on borrowing did tighten up a bit when interest rates went up. So I think we'll probably see that again.
Interesting. And look, you can't have everything. Like, we want economic growth in markets, and sometimes economic growth is going to come with some slight interest rate rises. So you can't have your cake and eat it all the time as an investor. Right, well, look,
I'm going to make a point on that, Will, and I'll probably try and bump through these next couple of slides relatively quickly. But I think I would have waited for Q&A, but I'll do it anyway. I think there's been a sort of almost over reliance or focus on yields in the past few years with regards to property. And I'm not saying that's not important. If you're a property investor who absolutely needs to make an income from your property investment, then you need to be very, very nervous, or not nervous, but very, very quizzical about the interest rates that you're going to see in the next 3 or 4 years, and the net yields you're going to get from that particular property. If you're buying for 5, 10, 15, 20 years, which is probably what you should be doing when you're buying real estate, certainly you should be buying for 10 generally, then I would always be buying for capital appreciation. And I'm not, as long as my yields are, I don't mind taking a cash flow hit as long as it's not unreasonable, because I'm banking on the fact that over a 10-year period, I don't think there's anything I've ever bought that hasn't seen me have a decent appreciation, some better than others. So I'll take my medicine a little bit with the yield. So yields are going to be, people are needing to continue to rent properties, and in most of the markets, certainly all the markets we operate in, there's a shortage of rentals. I mean, the rental market is extremely strong in the UK at the moment, and there are, in some cities, there are wait lists for properties. So your rental yields are going to edge up every year, 2, 3, 4%, not ridiculously. So your rents are going to be okay. Interest rates may go up at a greater level than your rents. They probably will for the next couple of years. So you need to just make sure, what is my motivation for buying this property? it's a bit like when you buy equities. Are you buying for your dividend, or are you buying for your long-term capital appreciation on that particular equity, or both? And you need to be very comfortable in your mind what your objectives are before you make that investment. For me, I would rather make an investment with a poorer yield and a greater capital appreciation. And that property that Lourens mentioned in London is a great example. He will not be getting a yield on that, or would not have done, in the same way that he would in somewhere like Manchester. But his capital appreciation, whether he'd lost £500 or £2,000 a year in net rental yield, he would have more than made up for that in capital appreciation. So I think that's a really important factor. In terms of diversification, I think, look, we've covered that. You can see from this chart that, you know, the home price index versus equities, it's not as scary, it's not as volatile, and it doesn't always appreciate it as much. I mean, if you'd bought equities the last 2 years, 3 years, you've had a great time for the most part, despite the little scary period at the beginning of COVID. So, but you know, property is one that, quite honestly, you put away and don't need to think about too much over the course. And it's something that, you know, I'm never going to not be able to invest in, or tell people that there are not many people in this world who are wealthy who don't own a reasonable amount of real estate.
Also,
okay, next slide.
The only thing to say about property as well, it's the only asset class I've ever hear people brag about, because because you're not around a barbecue or a braai one night and someone says to you, you want to really check out my bond portfolio. But everybody talks about a property in London, they talk about a property in Germany, they talk about a property in Portugal, as if it is just part of the course of the conversation. And it doesn't feel or sound like a brag, but immediately it just sort of stamps down that they have wealth of some nature. I really think it's a fantastic asset class that people around the fire can talk about.
That's great. That's very, very true. That's very, very true. Okay, so I think we'll try and spend a little bit of time on this one, and we can get through the rest of them relatively quickly. But I think this is a really important slide, because without this, I wouldn't have been able to start my journey in real estate and give myself the returns I had to keep buying and buying and buying and build up a portfolio. So leverage is exceptionally important. And while Will may have no clients who buy in cash, we have clients who buy in cash, and many of them live in China. And that's their particular choice. And a lot of that is about security and currency hedging. But, you know, and they may be of a level of wealth that it doesn't matter to them. But for the most part, for us normal people, leverage is incredibly important. And you can see on there how that works. And I'll just give a very basic example. But even if you take a 50% leverage, you're going to double your returns, and it really is not complicated maths. So, you know, if you buy $1 million property and it goes up by 10%, and you've made your 100,000, if you've only put down 500,000 and borrowed 500,000, then you've made 20% on your investment. So it's pretty simple stuff, and that little chart there is a way of explaining what is really nothing more complicated than what I just said. But it is very important. It's a hedge on the currency as well. Your eggs are all not in that basket. You're obviously buying and borrowing in the same currency, but for the most part, it also gives you the opportunity to remortgage as well. And again, that's how I made my money. You know, when I bought my first property, actually my first property, I put my mates in the spare rooms. They were my tenants from university. We all lived in a little place that I paid £52,000 for, and sold for 250. The first year I set up IP Global because I needed the money, but they paid the mortgage through the rent, and I put Sky TV in for them. And then you know, as soon as the property went up in value, I remortgaged, took out £20,000 and bought another one. And you know, I couldn't do that straight away because the property didn't go up in value immediately, obviously, but leverage is extremely important. And when you're 2, 3, 4, 5 years down the track, if that property, I mean, that, and I don't want to keep going about that because he didn't buy it, but if that particular property in London, you could have leveraged once or twice or 3 times already and sitting on 5 or 10 apartments. So there's risk to that too in terms of exposure, but mortgaging is very important. Next slide. Yeah, I think we're getting quite tight on time, and this is stuff that you guys can probably find on the internet relatively quickly, but you can see the forecast for Eurozone growth. Employment recovery has been slow and steady since the GFC. A lot of property companies avoided Europe when the crisis happened 10 or so years ago, but we didn't. We love Germany, and we wish we'd done more. We went for non-traditional Germany. You know, Frankfurt would be the obvious place. That was the first market we went to. Munich's too crazy price-wise, and it's hard to find stuff. Actually, I bought and sold and did well in Frankfurt, but Germany is Berlin has proved incredibly well. You can see the GDP growth is in Holland and London are the best, but again, Spain has returned extremely well from an absolute disaster 10, 12 years ago.
Tim, sorry to butt in. Just for our viewers that are watching, we've got a lot of questions coming in via WhatsApp already. If you could please just answer them ask them on the Q&A button. It's at the center of the bottom of the screen, and we'll try and answer those questions as we're going on. We'll try and keep us on the time schedule as well. But sorry to interrupt there, Tim. Carry on.
That's keeping me honest. So let's whiz on. I'm going to just keep going, Will, I think, probably. Next slide. Again, I think we move on. We've talked about Europe, and again, the guys can access the slides. You can see the latest house price growth amongst those markets, and also the dots are to January 20. I went through this yesterday with Will, you know, and I think the next slide is even has more countries on it. So if we can jump to the
one more on, yeah, there's two more, and then is it? It's
yeah, let's go to the that's the one, yeah. So this is interesting because you look at this, and if this was stocks and you were seeing performance and forecast, you'd say, right, I want to buy there, and there. But this is where property, and going back to what I said previously, is super important. You understand whether you can borrow money, what the interest rates are, what the cost of buying in that particular market are. So, you know, if I went through this list with Will yesterday, and I think virtually 3/4 of those properties markets I wouldn't buy in mostly because of legal political risk or an inability to borrow money. And I can just go through, you know, a handful of them. Paris, legally very difficult to buy. Some properties are not even available to foreigners. Very difficult to borrow money in Spain still. Beijing, you can't own as a foreigner. Hong Kong, you're looking at 15% stamp duty as a foreigner, up to 20 with other costs. Mumbai, can't borrow money, and so on, so on. So you've got to really understand where you can actually buy and borrow. And this is why, you know, slow and steady wins the race, and why we're in, you might say, traditional boring markets, but ones that you still get the returns without the underlying risk to your asset. Okay, I think you can see there's a little bit there on capital gains tax in some of the markets. Germany, I'd sold mine after 10 years because I didn't pay any CGT. But you can't get borrowing in Netherlands, which is why we, you know, generally we wouldn't be there. So that just gives you a sense of what your sort of out costs are on some of those markets.
Yeah, that's quite a nice graph actually. Sort of that looks at your entry costs, your hold costs, and your exit costs. Look, all of this stuff we can give you some advice on. So I think now we want to jump onto some questions.
Yeah, look,
right?
I think I just saw the Portugal one there, and the reason we're in Portugal, although there are costs to exit, and there are costs to exit in most markets, there are in the UK, tax costs. First of all, you only pay tax if you've made money. So, I mean, you know, people that moan about tax somewhat should be happy that they've got to pay tax because it's performed. But Portugal is such a great market because the cost of funding there, borrowing, is so darn cheap. And along with the fact that if you look at the forecasts and the past 10 years since the global financial crisis, you can't fault what they've done in that market to encourage foreign investment, to encourage people to go get visas, and the property market's really benefiting from that. So I'm very, very bullish on Portugal, notwithstanding the fact that A, Lourens bought there, and B, it's a brilliant place to go and visit as well. But I think we probably got through that as quickly as we could. Sorry if I spoke a bit quickly there. So should we do a Q&A now? How is this working?
Yeah, I think, Mark will waiting with some questions, I'm sure. I think the first one, just from my perspective, worthwhile. I think we're all okay on the interest rate one. And how do you see this current wave of inflation, how does that affect building costs, etc.? And do your developers have the pricing power to absorb that margin? Does that margin get passed on to the client? Where do you see that going, Tim?
Oh, it gets passed on to the client. And if they tell you otherwise, they're not telling you the truth. So I think you'll see property inflation without a shadow of a doubt. If I just look at the UK as an example of margins for property developers, back in the day, a very, very crude way of looking at property development was a third, a third, a third. So they used to spend a third of their capital or borrowing on the asset, on buying the land, and a third on building, and their margin was in the low 30%. Most developers now are operating at a return on cost of somewhere between 15 and 20%, big developers. So there isn't much more room in their balance sheet for most of them to go beyond that unless they're small developers. So in the main, it'll be passed on. The big guys can obviously have bought options on steel and God knows what, so in a slightly more comforted position than the small mid-sized developers. But what you generally see in inflation is it being passed on, and property prices will react accordingly. So I think you're going to see property inflation across the board. What we're seeing in the UK is a sort of perfect storm for investors in a way at the moment, where property prices are going up, but the accessibility of new properties and land is an all-time low in many parts of the UK, because most of the people who give planning permission have been sat at home on furlough for the last 2 years. So you have huge backlogs of planning permissions. So stuff not being given, which is why we're struggling a bit to find stock. I think what you're going to see, at least for the next 2 or 3 years, if you buy well, is strong capital appreciation during the process of the build, if it's a new build, but also a real struggle to find good quality stock in good areas, because developers are sitting there with planning applications in, or landowners in the main. You know, land isn't you don't sell land without planning generally, if you can avoid it, because the value's all in the planning, but they might have to wait 6, 12, 18 months, some of them, to get the planning applications through.
Yeah, that's excellent. Thank you, Tim. And one of the questions we got here on WhatsApp is just bringing in the currency point. So I've just popped up a slide that we use when we're trying to explain this to clients, and particularly those that are in emerging markets like South Africa. I think a lot of people sometimes forget that the rand is in the same basket as the Turkish lira, the Argentinian peso. And if you want to see what scary inflation looks like, you only have to look at what's happened in Turkey recently, and again underlines why primary currency is the thing. But one of the common misconceptions is that currency, is something that's only gone wrong, quote mark, since the Zuma era. But actually, when you look at it, this is a long-term trend. And I think this was best underlined actually when a client of mine who's actually got a property in Bishop's Court, he told me this story. It's a little bit worse than your one, Lourens, which was that he could have bought a property in London in the 1980s at £100,000. Okay. It was about 1-to-1, so it was 100,000 rands, £100,000. That property in Bishop's Court is now worth 23 million rand. So he's done quite well. Okay, 23 million rand. But the property in London is worth 14 million pounds that he could have bought. So at current exchange rates, that's nearly 300 million rands. So look, take the interest rates, take the currency depreciation out of the question. Let's just use a unit of exchange being a mansion in Bishop's Court. By buying in property in Cape Town rather than London 40 odd years ago, the client has effectively got 12 less Bishop's Court mansions worth of value. Wow. That's why this is such a powerful message, right, guys? I mean, is there anything you want to add to that before we move on to some of the questions from the viewers?
No, I think you've said it all. It's frightening, isn't it? Yeah, you've said it all.
Yeah. Okay, let's move on to some Q&A then. So a lot of questions about liquidity and borrowing of money. One thing I would say, guys, we'll go on to these questions in a second, is that the UK mortgage market is not what it was a year ago in a good way. Okay. With the COVID pandemic, with the stamp duty cut, liquidity was quite tight. It's gone completely the other way, hasn't it? We're now finding interest rates. I've just done a mortgage for a client from South Africa, sub 3%. Okay. It was the first one I've seen at that level. Not saying that everyone would get it, but I'm saying that they are coming into that kind of territory. So one of the questions we've got here from Michelle is, I'm 69 years of age. Could I get a bond or a mortgage effectively for an investment property overseas? What do you think there, guys?
Maybe I think you're probably closer to it than me. Yeah.
Could be difficult in the UK, right? Because lenders, you're probably going to find, and I'm sure we've probably got a mortgage broker on the call somewhere. We could call them up, but ultimately, and we own a mortgage brokerage, right? IP Global, that's part of our offering. But ultimately, you might find most lenders would only lend to you, say up to maybe 65. Someone like NatWest, a very cautious lender. You might find someone a little bit less cautious lending to maybe 70 or 75 years. So the first thing to do is you might need to look at an interest-only option, obviously, because you haven't got the time to repay the loan down in a short period of time. Because on cash flow, that'll hurt, right? Tim said he was willing to suck up a low yield, but ultimately paying down a £200,000 loan over 4 or 5 years is going to be painful. But one thing I would say is in Germany, we do have a more flexible lender. Not saying we would encourage it to the extreme, but we have a lender that would lend up to actually 90 years old, subject to you being the right sort of ticking the right boxes. Now I'm not going to encourage someone to do that by all means.
Well, look, Will, I think the thing is people have got a skewed view on mortgages and age. And as I get older, I get more worried about this. It's something you don't worry about for most of your life. But we're talking about investments here. We're not talking about a traditional mortgage where you want to pay it off before you retire, because you're not funding it with income. You're funding it with yield, with rent. So my absolute advice to this to your client would be sit down with your advisor from Holborn, have a look at what's available, and give it to them and us, and we'll go see what we can find you. In Germany, I'm sure we could. In the UK, it might well do, but with a lower loan to value. Then don't buy anything until you've got an offer in principle. And I would be probably buying something that gets built in the next 12 months, where you can get an offer in principle in black and white from your lender before you put any deposits down. But the opportunity, I would think, would be there. You just need to take some advice.
Yeah. Absolutely. And that sort of feeds into the similar sort of question from Carol. Carol, thank you for your question. How would you get a local mortgage for an offshore property investment? Very simple question that we deal with it all day, every day. So we've got a team in Holborn that look after a number of specific parts of our business, one of which is helping you get a mortgage for either a new property, or if you've been in the UK for a period of time and moved back and you've still got an old property there, why not release some of that hidden cash that's sat there in that property, probably in Southwest 19, and use that to maybe go and leverage some gains in the market and go and purchase other investment property, just like Tim was describing earlier on. So long story short, Carol, very, very easy for us to assist you with that. Just speak to your consultant, we'll be able to assist there. A question here from Edward, guys. For long-term planning, do you recommend a trust or company to protect from inheritance taxes? I know that's a tricky one to answer, from a legislation point of view, but where and when would we start looking at this, do you think, from a threshold perspective?
Yeah, I mean, look, we should always say, just to protect ourselves. I knew that we're not tax advisors, but I've been in that position too, and I'm not necessarily fully au fait with the rules and regulations in South Africa. But what I will tell you, in the markets that we operate in, it's pretty tricky to try and find a way of putting your asset in a place that's not going to find its way back to the taxman one day. They're not that stupid anymore, unfortunately. So there's sometimes a misconception that setting up companies and trusts is the smart thing to do, and sometimes it ends up costing a lot of money. And I've done it myself, and then had to unwind them and thought, well, why did I ever do that? Certainly as well when it comes to leverage, and if it's important for you to get bank borrowing, some of the banks will have different views on companies and certainly trusts. So you'd need to take some local advice, but there is no simple way of buying real estate in our markets where it will simply bypass your any inheritance tax. But if you were to talk to whoever sets your trusts up, that might be a more sensible way. Certainly putting in a company vehicle it is not going to help you, because it will be taxed as inheritance tax, just like all your other assets, because it's only an SPV that holds the property. It's not a operating business. It's a property business, and propcos are taxed.
Okay, and then moving on, we've got a question here from Warren. Again, a lot of mortgage related questions, which is something that we can absolutely help with. So what percentage of the value of the home loan would you need to put down as a deposit to get a mortgage loan? I can answer this one on behalf of what we've got going through at the moment. So, realistic, what we say to clients is somewhere between 60 and 75% loan to value. Okay, so putting down somewhere between 25 and 40%, and you're not guaranteed to get a mortgage, but it's highly probable that you will get a mortgage offer on that. That being said, like I say, the liquidity in the market is improving. I just saw one literally last week go through at 85%. It's the first time I've seen a loan to value north of 75% in the market for a number of years. So yeah, the lenders are coming back to the table. So hopefully, Warren, that gives you a bit of an idea of what you can potentially get from a liquidity perspective. Okay, guys, here's one from Marana. So property goes through periods of low real yields and no capital growth. We've seen that in India for 10 years now. So maybe a currency question here as well, actually, about selection of markets. The prior 10 years, it was great yield and fabulous capital growth, up to 90% mortgage. How do you make sure you don't caught in the down or stagnant cycle?
I don't think you can really compare the Indian property market to the markets that we operate in. And that isn't to say that, I mean, goodness, I tried to buy in India 20 years ago and just gave up in the end. It's so tricky. And, I was looking at a place like Pune, which I'd be telling great stories about that as well now for what I would have made there. But the market there is still a market where there are very few, very rich owners and dynamics that are a lot more immature as an economy than places like Germany and the UK and Portugal, the markets we're talking about. If you were to take a graph now, go online and look at a graph of UK property, just take London. Since the Second World War, you will have never seen what you've got in India happening now ever happen. So I can't say it never will, but it's given that it hasn't happened for 70 years, I don't think you'd ever see that happen. Generally, what you'll see here is you might see some stagnation in property appreciation, but during those periods, you're normally seeing better yields, and then vice versa. But property in London, as an example, has doubled every 10 years since the Second World War, and any 10 years you want to pick, and that includes downturns. So I think, for instance, if we took a graph of Dubai and tried to overlay that against more traditional property markets like the UK, like Germany, you'd never be able to see a correlation, because they're driven by completely different factors. They're driven by investor only, generally, in a lot of those markets. And that isn't the case in the markets we're talking about, where you're talking more than 90% of every postcode is, well, sometimes 99% of every postcode is owned by people who actually live there rather than have bought them to speculate.
Great stuff. Thank you for that. Okay, we've got a couple of raised hands here, so we encourage you to do the questions through the Q&A button so we can get to them as quickly as possible. But Heinrich's got his hand raised, so I'm going to just allow Heinrich to ask your question verbally. Heinrich, if you want to just unmute yourself, what's the question for the panel here? Oh, you unmute yourself.
Mark, I actually think I pressed the wrong button. Can you hear me?
Yes, I can. Go for it.
I didn't have a question, so I can think of one maybe.
By all means, go for it.
Give me a second to think about something. I think one of the questions I would like to maybe just have a quick discussion on this that I haven't heard talk about before is just the process of compliance and anti-money laundering, and just in general the A to Z sort of factoring that we take into our property investments offshore for our clients. Maybe Tim can just give a quick answer on that one, on exactly what it means A to Z and what we do.
Yeah, that's a great question and very, very easily covered. The great thing about real estate, and from my perspective and the company's perspective, is we don't deal with your money. So you don't send us your money, and we don't want your money because that puts us in a risk position. So in all of the markets where we operate, there are very strict anti-money laundering processes and legislations in place, and also KYC, know your client, for those of you not familiar with those acronyms. So basically, you will, when you buy a property in any of these markets, you'll pick a lawyer. We've got a panel of lawyers, which we recommend you use because they're familiar with you working with offshore investors. Equally, you can go and see your own lawyer if they're qualified to do transactions in UK, Germany. Those lawyers will need to vet you, KYC you, and make sure that they go through their normal anti-money laundering checks. Where did your money come from? How did it get into that bank account in the first place? And they'll run a check on you as well, individually. We have, to be honest, we have quite a bit of that in Africa. not so much in South Africa, but some of our other clients outside of South Africa. We have it in other parts of the world. We have it in China as well. But everywhere our clients will need to have been checked before the money. You would pay your money to your lawyer, and that money would then be paid across to the lawyer of the developer. So and there would be in the same way, all the developers are checked as well before we buy real estate from them. So you will go through all the usual checks and balances that you would do for any normal investment, but the money does not bounce anywhere other than to your lawyer and to the lawyer of the developer. And it's a very, very clinical, straight process. And we have had clients who failed AML over the years, and we've had clients who are connected parties to political pips, politically connected, and sometimes the lawyers won't want to act for them, or the banks won't want to lend to them.
Okay, thank you for that, Tim. Lourens, you've got a question. Go for it.
Yeah, so obviously we know that the magic formula, or part of the magic formula that you use, Tim and Will, is it has to be in a principal currency. We know that you have to get leveraging in that particular country. We know that you don't want to be taxed more as a non-resident than a resident. We know that you want ownership rights. So the countries that you mentioned, the UK, Portugal, Germany, they all fit that bill. But another country which you've had projects before also fits that bill, which is Ireland, but currently not investing there. Why? And has something fallen out the bus there? What's the different story in Ireland now?
No, nothing's fallen out of the bus. The biggest problem we've had there is mortgages. I guess the second biggest reason that is a lot smaller is access to assets. But the biggest issue is we had real trouble with mortgages. We had a nice little run with Ireland, and the clients have all made money, and the market's done really well. I love the market there. But we just literally struggled to get any mortgages on any assets. And most of the people buying in Ireland will be clients in places like Hong Kong, Dubai, Middle East, South Africa, and they all want mortgages. So, we won't do a deal where we have two clients who are going to buy cash only, and everything we looked at, we couldn't get debt. And I should probably know why, and Owen would know why, who looks after Germany and was doing Ireland, who's Irish for us. But that's the reason why.
Brilliant, thanks.
Great stuff. Okay, we'll just wrap up with two more questions because I'm conscious of everyone's time. So one question here from Edward. Edward wants to know, can we rent out properties in a way that they can be, for example, through Airbnb, and then maybe you could go and stay in your own apartment? I know a number of clients that are doing this very, very successfully, particularly in some of the centre locations now that the pandemic is coming towards a close. So yeah, absolutely. It's your asset. You own the leasehold if it's an apartment, and so therefore you're able to do with it as you wish to get a return on that.
Mark, can I make one point to that, just really quickly? I'm glad he's asked that question, because over the years we've always run an AST model, which is a short-term model where clients are renting for a year, 2 years, 3 years at a time. Very stable, very sensible. But there are some of our competitors and some of our clients indeed will go off and work on short-term rentals and get much higher yields, slightly less stability, but it works. So there are companies out there who will take your property and run it as a short-term tenant model. You'll pay slightly higher fees, but the yields generally are better. We are looking at that option at the minute because we have clients who want it. So it might be that we have a building with 30 apartments in where 15 of our clients go with a long-term rental and might get 4%, 4.5%, 5%. And maybe 6 if it's up north, and then you might get clients who go for the short-term let model where they might get 7, 8, 9%. But that means the property's turned over much more quickly. And some people don't like the idea of that. Some people don't care; they just want the yield. So we're definitely looking at that at the moment, and we will be launching that model in the next few months.
Sure, excellent. Right, last two questions then. So Carol's asking, would you recommend investing in completed properties or ongoing proposed developments, and what are the comparable risks and benefits? I'll grab this one just if you don't mind to start with. So, been a landlord myself for 20 odd years in the UK. And one of the things I advise clients on is just think about, how do you want this investment to run? If you're happy jumping on a plane to go and fix a boiler or fix a roof or something like that, by all means look at secondhand property, but just be mindful of those kind of challenges when you're based overseas. If you want something that's easier to manage, so therefore it's within warranties or guarantee periods, something like that, then yeah, newer build property is the way to go. And actually one of the things that we recommend, and I'll hand over to the guys in a minute, is that you can actually also get quite an interesting uplift in the value by buying off plan earlier on in the process. But Tim, Will, what would you recommend?
I think you've covered it off, unless Will's got anything. I mean, you get a 10-year build warranty when you buy a new apartment, which is quite nice to have. Things are less likely to go wrong. So I generally think you are better off if you're living in another country, because the interesting thing is you're not paying more money for it. So again, in some places, I'm not doing this to Dubai on purpose, Will, because I love Dubai. I've had a lot of fun there, but you'll pay more. You pay a lot more money for a new apartment in Dubai next door to an old apartment. That will never happen in Berlin. The price per square foot is the price per square foot you might pay a tiny increment because you've got a new stuff in there, but you're not getting ripped off because it's a new apartment. So why not buy a new apartment? Because you're less likely to have to repair everything in the next 5 to 10 years.
Yeah, fantastic. Thank you, Tim. Cheers. Well, right. Okay. Last question then. So question here, do we offer purely investment properties, or can you use this with property purchases where owners can, for example, stay in the properties? So again, one of the things that we do as the wealth manager in the discussion really is just to try and understand, what are you looking for? If you're looking for the best case investment property somewhere around the world, we will help you find it. And using the research that the likes of IP Global and the huge amount of effort and experience they put in, we will find you the best in capital appreciation, the best in yield. If you've got or you're looking for a property you want to go and live in, we're not necessarily going to know which way you want the bathroom to face, or that you want it to look out over this bit of view and what have you, because it's more of an emotional decision. So really, where we fit in is finding you the best investment case. If you're looking for something to live in, it's still an option, but it's more of a challenge for us to get that absolutely right for you. So Will, anything you want to add there from an experience point of view on what we can assist clients with?
No, I think you hit it on the nail there, really, with that reply. Most of what we do, obviously, is talk to investors. Well, just going back, Mark, if I can, to a previous conversation about yield. I mean, and security. It's actually possible to. We talked about short-term lets. We talked about the sort of longer-term, more traditional model. But we can actually insure rental income, guys. So if you buy a property in the UK, and you speak to the right people, you speak to your advisor at Holborn, you may be able to pay a small premium of a few £100s, maybe sort of £150, to actually insure that rental income. So that if your tenant lets you down, doesn't pay the rent, you follow a process, you get that paid out by an insurance company. If there's any issues getting the tenant out, it's claimed, you can claim those costs back. So there aren't many investments out there where you can get into a market, leverage it, play the capital growth game, and insure the income during the hold. So just something interesting to consider if you're thinking about buying.
Great. Well, gentlemen, thank you very much for all your input. Ladies and gentlemen that are watching today, thank you so much for taking the time to come and listen. We've only been able to really touch the tip of the iceberg. The best thing really, as we always recommend, is sit down with your consultant from Holborn. Really please do look at what investment property can do for you and your family in the longer term, how it can protect you against a devaluing rand, how it can protect yourself against things like interest rates and various other challenges that Lourens very eloquently talked about at the beginning of the presentation. Gentlemen, anything you want to add there before we wrap up?
It's been an absolute pleasure. Thanks very much. Thanks for having us.
Thank you, Tim. Thank you, Will. Thank you, Lourens. Have a great day, ladies and gentlemen. All the best.
Thank you. Bye.